The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Okay. Hello, everyone, and welcome to this session from Mirae Asset, where we will cover about our latest product offering, our Mirae Asset Balanced Advantage Fund. And thank you to HDFC Securities for arranging this. My name is Mayukh Datta, and I take care of the product team at Mirae Asset. Today, we are talking about our NFO and a new product which we have for all our partners and investors, and especially for all clients of HDFC Securities to consider this fund as a viable alternate for their investments. Before we talk about it, just to quickly tell you about, we have been in India for now almost 14 and a half years and are managing about close to 1.04 crores of AUM, the lakh crores of AUM with almost 53 lakh folios with us. We have couple of other funds in our hybrid schemes, and today we are talking about our latest offering in the hybrid category, which is the Balance Advantage Fund. Now, the Balance Advantage Fund actually comes under the dynamic asset allocation category in the hybrid investments for investors. If we were to talk about this product, what are our views? How do we look at it? When you look at the whole investment experience landscape, many times what happens is, because we tend to have unrealized goals, so we make investments in a hurry, and those investments can turn out to be volatile. It could be underperforming. It could also have products where our investment is not in line with our requirements or possibly our risk profile, and also from an horizon mismatch, which is we invest into low yielding products from a long period of time, and for a short period of time get to invest into high yielding but high risky products. So our risk, time and requirements sometimes get mismatched, because of which it leads to some lifestyle compromises, meaning that we don't have the investment maturing for us when we actually need the money for that purpose, and therefore we need to make some compromises for that, which then leads to this situation of we try to hurry our investments, and we then get into sorry, I hope you can see this here. So we get into investments by which where people are getting affected by volatility. They are getting affected, their investment decisions get affected by noise, views, signals which is coming from all sorts, which then makes them shift their goalpost, let go of their goals, and therefore the purpose of investment, and then get affected by whatever is happening around with them. Of course, after that, what happens, what affects everybody's investment is they would look at their biases. When people are all flocking into equity markets, or on the reverse, exiting equity, we would tend to get affected by that, what is happening around with us. Those are our investment biases which start affecting our investments. And the culmination of all these emotions is that at the end, when markets are volatile, there is an inherent fear which comes into investors' mind, and rightly so, it happens. And but at the same time, when they exist markets, when they look at the long term, it is a feeling of regret, which is they had missed out on the subsequent moves which the markets make. Then the regret is mostly on a long-term emotion, when they did not have the right participation in the right asset class for the right time and goal in mind. So if we were to meet in together and we were in a room, and I were to give you different color post-it notes and were to tell you that why don't you put in your feelings or reactions when you hear these three words, which is return, risk and experience, many of you would have probably responded in this manner, saying that in your returns, your expectation would be that any investment which you make should be beating inflation and should be positive post-tax returns. On the risk part, it should not, it should be lower volatile, it should change as per the time, and it should be able to capture the broad signals. And from an experience, which is most important for investors, that it should be giving you a hassle-free experience, and it should be reducing your anxiety. Nobody would like for an investment which only increases their problem over a period of time. So with that, if you were to, here is an example for people to consider. For example, if this is the data of how equity markets had moved, this is specifically for Nifty 50 data, that as in 2008 when markets were down, how did people react during this sharp fall within a period of 10 months? So within 10 months, from January 2008 to October 2008, the market fell by about 60%. And when markets fell by 60%, naturally the investors' reaction would be to exit equities because they would like to stop loss and do not want to lose any more money further. Probably some of them would not have even waited till 10 months and would have exited the markets before that only. So it's a very sharp fall in a very short period of time. But what happens is this short fall is actually 60% sharp fall is only for a very short period of time, which you can see as the gray shaded area on this graph. The rest of the time, the markets were up. So imagine an investor who would have moved out because of fear would have regretted over a long period of time of not staying invested or not having a participation in the equity market because of the subsequent move over a period of time. So the idea which we are trying to base our thesis for this product is fear of volatility is a short-term emotion, but regret is a long-term emotion of missing out of the relevant asset classes by not having a adequate participation most of the time. And that is what something a dynamic asset allocation product tries to achieve. So what a balanced advantage fund category tries to give to all our to any investor from an experience is it tries to give a certain participation rate through all phases of market, that the investor is invested into equity or debt or arbitrage in the right proportion which is required at that given period of time in the market. To reach that right proportion, it has to be based on some rationale, and that rationale is that model on the basis of which the fund invests into equity, debt, or arbitrage. Why does the model do that? So that it is able to manage the extremities which markets show, which is periods of high euphoria when people think that there are no other risk on equity and they invest full-heartedly, or at the time on the extreme other side, which is at extreme fear, which is, let's say, 2020 when COVID started, or 2008 or 12 or 13, is when how does an investment able to manage the extremities which are there in markets, which then induces investors to either come into equity markets or get out of them. So, or probably in between of hope when they see markets being volatile or being sideways for a long period of time. So to be able, and the ignorance being that there is investors or anybody would have lesser information about to take a call on where they should be investing in equity markets. And to be able to achieve this reduction of impact of extremities, the model should have a strong rebalancing thought process so that over a long period of time, it is able to give a positive outcome by rebalancing. So these are the four basic tenets of a dynamic asset allocation. It should give you an optimum participation rate into asset classes. To be able to do that, it should be based on some sound proof of rationale, which is the model. The model should be reducing the impact of extremities of markets which is basically volatility management. And it would be able to do that by having the right rebalancing thought process. With that, that is why we are bringing in our Mirae Asset Balance Advantage Fund, which is to give you an optimum participation in asset classes and not anxiety or perspiring after investing into any such product. So to do that, we are basing our thought process on the basis of there should be a framework to be able to achieve this participation rate. While our scheme information document, our SID, allows us to be 0 to 100% in equity and debt, we have put up a framework, and that framework is equity being 30% in times of when markets are highly overvalued, and 80% of the fund being invested in equity on the higher side when we find markets to be highly undervalued and therefore should increase our equity proportion. We will have an equity arbitrage position also in the fund, which helps us reach our equity taxation. And we have a fixed income, which is our debt allocation, which is minimum will be 20% and higher will be 35%. This model for achieving our net equity position will be based on Nifty 50's price to book value and on price to earnings valuations of the market, which will give an indication of whether markets are highly valued, undervalued, or somewhere in between, for us to be able to achieve our net equity position. To be able to do that, what is the basis and why are we using these two metrics? We are using these two metrics because when we look at Nifty 50 as an index, for us to be guided on where market valuations are and therefore what sort of equity percentage should be in the portfolio, we think that Nifty 50 is a very asset heavy index and something which comes with a long data history for us to be able to see how markets would have behaved over different cycles during in the past. We find that Nifty 50 has being asset heavy, a price to book value allows us to look at such businesses over a long period of time. Also, that during times of high volatility, when companies' earnings are subdued or they come under heavy pressure, for example, in 2020, when companies were being shut down because of COVID, so naturally there were not much earnings. So naturally, price to earnings will show that we need to move out of equities. But price to book value then allows you that little bit more of a long-term view where you can take a slightly longer view than P, saying that while businesses may be under pressure for 2, 3, or whatever quarters, their inherent strength of those businesses are very strong, and therefore price to book value allows you a little bit of a leeway to take a slightly longer term view in India on Indian equities than only price to book value. Both are important, but the larger weightage of this model will be to price to book value. And this is also coming from the fact that when we started, we showed you that slide saying that on a long term, India is a growing economy, and therefore the markets and Indian economy has been growing over so much period of time. And as it continues to grow ahead also, having that price to book value just allows you to anchor the model and take a slightly longer period of time rather than only earnings, which could be of the only past 4 quarters, which is the trailing PE, or it could be for the forward looking 4 quarters of earnings. So rather than only looking at 1 or 2 or 4 quarters, you're looking at a slightly longer period of time. And on a longer period of time, we should have the rightful participation in equities, which can come from the price to book value. Along with this, we also have the position where the fund manager is overseeing this model. There are many other inputs when you are considering equity as an asset class. So, and from a long period of time, there are impact of interest rates, currency, FI flows into India, economic conditions, economic environment, and so on. All those variables are being looked forward by the fund manager, and along with the valuation metrics, the fund manager is able to take the rightful call on what should be the right participation at any point of time. So when you look at a business, we are saying that when you look at any tree or any orchard and others, what you look at is only what is above the ground, which is the results of the health of the tree, which is your roots, which are your fruits and the way the tree looks. But the tree is able to sustain itself during good and bad times is because of the roots, which are not visible so much above the ground. But when you look at how the tree will sustain over long periods of time is because the roots. So if you were to convert it, the roots are the balance sheet of the business, and the best way to assess the balance sheet of the business is by price to book value. The fruits are the results of the business of the tree, and therefore the results of the business are earnings, which are visible in the profit and loss account, the income statement of the business. So that's how we are basing our model on. When we did this data and we checked on how this model behaves over a period of time, we took data from April 2006 till June 22, and as we continue and we tested the model across over a long period of time, we found that the lowest the equity position went to was in the times of high valuations of last quarter of 2007, and from there went in 2008 when markets fell down. The model immediately increased its equity allocation to 80%. The next time it hit 80% was somewhere around 2012 second half, and then for a very short period of time at end of 2013. The next time it hit the highest equity position of 80% was naturally at the time of COVID in March and April 2020. And as markets recovered, the equity position started coming down. So what effectively this model is trying to do is try to increase the equity positions as markets become cheaper, they become more attractive and able to come out of equity as markets tend to go into a higher valuation zone. So on an average, this model has been able to achieve a 60% equity net position most of the time. Currently, as you can see, for the last 1 year, it has been somewhere between 45 to 50% and currently around at just a shade around 60%, which is the long-term average. Here we have seen, to give an example of how rebalancing has worked for an investor over a long period of time is as follows. We have checked how did the model behave when the markets were tumbling down, and subsequently after from the bottom when the market went up, what was the investors' participation in equities. So if you look at it, between Jan 2008 to October 2008, Nifty went down by 59%. This model went down by 38%. So the difference was 21. 21 divided by 59, which is the reduction on fall, how much the fall was able to reduce the experience of volatility for the investor, that was 36%. So this model therefore fell 36% lesser than the Nifty 50. Subsequently, from October 2008, the market went up till October 2010, which was the next high. During this period, from the bottom till 2010, the Nifty went up 149%. This model went up 106%. Therefore, the investor got 71% on the upside. And these are the 5 such examples. As you can see, from Jan 20 to March 20, Nifty went down 38%. This model went down 28%. Therefore, the investor got a downside protection of 28%. Subsequently, from March till November 20, when the Nifty again rallied, which was 62%, the model was up by 47%. Therefore, the investor got 76% of the upside. So the gray lines, as you can see, are the downside protection on your left side, and the gray columns on your right side is the upside participation the investor got when the Nifty subsequently moved up. This would then give you an idea of how is the model's experience for the investor is during different business cycles. On the downsides, this model is trying to protect somewhere around on an average of 35 to 40%. On the upside, it is able to give somewhere around 70 to 75% of the upside, therefore being dynamically managing, therefore reducing the bear market impact on the investor's experience and giving them a participation rate for when the markets are on the upside. We had done a SIP rolling return to just see how this model behaved. We saw that while Nifty on a 5-year rolling SIP gives a return of 22%, the model gives about close to about a little less than 17%. But what is more important here is to see that the experience for the investor is much lesser, because the standard deviation, the volatility of the funds are much lesser when compared to the Nifty, and which is natural outcome of such a product, because it carries an equity, debt and arbitrage position, therefore lessening the impact of volatility on the investment experience. How will we invest in equity and how will we invest in debt? On the equity part, we will continue to hold it the way Mirae Asset has been managing its equity portion. We would be looking at a bottoms-up approach where we look at business management and valuations when we look at any stock selection process. Within the equity, we would have a large cap bias with a flexi cap framework. In any flexi cap product, you would have somewhere around 70 to 75% into large cap, 15 to 20% into mid, and 5 to 10% in small cap, which carries therefore a predominant portion of large cap. That is something which we would like to carry on into this product as we are managing in our existing hybrid funds. The way we manage our equity portion, this is how we will also like to extend the same logic into the new product also. On the debt, we would actively take a call on where the interest rate scenario in the country is. For example, as we start the fund, most of the interest rate looks to be hardening, and there are shorter term interest rates are high due to the inflationary trends, which therefore makes it that we should be in the shorter end of our debt portion, which would be somewhere between 2 to 3 years. And within that 2 to 3 years bucket, we would look at papers which we think we are getting a good coupon along with a good credit rating, and then hold on to such papers, which is therefore translates into our buy and hold strategy. Once we have got an interest rate tenure call right, then we take the right paper which helps us in this portfolio and then hold on for those papers so that we are able to get the maximum impact of the coupon or the carry which these papers carry. The debt portion will also have about 15% allocation to cash, TREPs, treasury bills, because they help us keep some cash portion for both debt and equity fund manager. And it also helps us carry certain treasury bills to provide for our arbitrage positions, because the fund will carry an arbitrage position, and all arbitrage positions need to have a margin component to it also. These are fund managers who will be managing the fund. Mr. Harshad Borwake and Mr. Mahendra Jaju. Both of them have been with the AMC for now more than 5 years plus, and Mr. Jaju is our head of fixed income and is managing our debt investments, and is also the manager for our hybrid schemes. Mr. Harshad Borwake has been with the AMC from 2016 onwards. He is managing our banking and financial fund, and he is also the head of research, and he's also managing the equity portion for our existing hybrid products. So in a nutshell, to summarize, this is how our fund would look like. This is a model-based approach where we are putting higher weightage to price to book value, lower to price to earnings, with fund manager overseeing this model. The allocation on an average will track Nifty 50 with attempts to smoothen the volatility of Nifty experience, equity experience, with a long-term average has been about 60%. The participation rate is to reduce the volatility for the investors experience, protect the downside, and give an effective participation rate when markets are on the upside. The equity will be managed with a flexi cap approach, which carries a large cap bias. Debt will be an active interest rate duration call, and after that it will have a papers which we would like to buy and hold. Arbitrage helps us ensure that our fund is always providing equity taxation to the investor. It helps balance the asset class also, and at times of volatility, arbitrage can give a slightly better return, which can impact positively on the fund. So with that, that is our scheme details. There's an NFO which is currently going on from 21st July till 3rd of August. The fund reopens for normal ongoing purchase and redemptions from 12th August onwards. The benchmark is Nifty 50 hybrid composite debt 50/50 index. The taxation will be equity. The scheme classification comes under the dynamic asset allocation category. That's some of our disclaimers. I'll stop here. Thank you so much for hearing us out. Thank you for the opportunity. And if there are any questions, I'll be happy to answer. Any questions? Checking the chat box. If there is anything, please put the questions on the chat box and I would be happy to answer. So I'll just stop showing screen.
So there is no question. We can conclude now.
Okay, thank you then. So can I exit now then?
Yes, we can exit.
Okay, thank you very much. Thank you. Take care.